Hello and welcome to Earnings Echo. We put together the most important information about Monday.com. Imagine growing your company's revenue by 20%, adding hundreds of millions of dollars without hiring a single new employee. That's the dream, right?
Oh, absolutely.
So today, your mission is to see exactly how Monday.com is turning that dream into reality with their Q1 fiscal 2026 results. We're going to dive into what it signals for their future. Let's just jump straight into the hard numbers. Did they actually beat the street's expectations this quarter?
They did, yeah. They absolutely outpaced expectations across the board. So Q1 revenue hit $351.3 million. That's a 24% increase from this time last year.
Wow.
Right? But what's really striking is how much of that is flowing to the bottom line. Their non-GAAP operating margin, which is basically the profit from their core business before complex accounting adjustments, that stood at 14%, delivering $49 million in operating income.
And for you investors out there tracking per share value, diluted net income was $1.15. But the metric that really stands out to me is the adjusted free cash flow margin hitting a massive 29%.
Yeah, that generated nearly $103 million.
Exactly. That's actual cash in the bank after keeping the lights on. So a strong Q1 is a great snapshot, but as the data suggests, they can actually maintain this momentum through the rest of the year.
It does, actually. Management confidently raised their full-year revenue outlook to between $1.466 and $1.474 billion.
Okay. Locking in, what, an expected 19% to 20% year-over-year growth rate?
Yep, exactly.
Well, the top-line numbers look fantastic on paper, but I always get a bit skeptical here. Are they just squeezing more money out of existing clients by, raising prices, or are they actually winning over new, massive enterprise accounts?
No, the segment metrics show true enterprise expansion. It's definitely not just price hikes. Look at the upmarket traction. Customers bringing in over $50,000 in annual recurring revenue grew 32% year over year to over 4,500.
That's huge.
And the heavy hitters, the cohort spending over $500,000 annually, that surged by an incredible 74% to 99 total customers.
That is a massive jump for the $500,000 tier. To understand how they're pulling this off, you really have to look at their net dollar retention, or NDR. Think of NDR like this. For every dollar a customer spent with them last year, how much are they spending today? Overall, it sits at 110%.
Right, but for that $50,000 plus cohort, it's an even stronger 116%.
Which proves their land and expand strategy is working flawlessly.
Yeah, it really does.
It's essentially a Trojan horse strategy. They get adopted by one small team for a relatively small fee. The employees love the software, and before you know it, it organically spreads across different departments.
Until it balloons into a $500,000 enterprise account.
Exactly.
And winning those massive enterprise deals usually requires an army of sales and support staff. Which brings us to a really fascinating dynamic in their cost structure.
Right, because aggressively chasing that kind of hypergrowth usually burns through a ton of cash. So how did management say they plan to control expenses while scaling up so fast?
Well, this was probably the most crucial margin-expanding statement from the CFO on the earnings call. Total headcount will remain largely flat for the rest of fiscal 2026.
Wait, projecting 20% revenue growth with zero new hires? How is that mechanically possible?
They attribute it directly to internal AI productivity gains. They are using AI to automate routine engineering, support, and administrative tasks.
Oh, I see. Meaning their existing workforce can handle a significantly higher volume of business without adding extra hands.
You got it.
So they are drinking their own champagne, using AI internally to drive efficiency, but they're also monetizing it externally. Management highlighted the launch of their AI work platform and a major shift toward consumption-based pricing.
Yeah, they actually noted that 10% of their net new annual recurring revenue is already coming from these new AI products.
That's incredible.
And that shift to consumption-based pricing is key. Instead of just charging a flat fee per user seat, they can now charge based on how much the AI is actually being utilized.
Right. And on top of this operational success, management is aggressively returning capital to shareholders, right? Executing $553 million in share repurchases in Q1 alone.
That is a serious vote of confidence in their own stock.
So bringing this all together, what is the definitive echo you need to take away from today regarding Monday.com's long-term investment story?
I'd say the core thesis here is proven operational leverage. We are watching Monday.com successfully transition from a traditional rigid seat-based software model into a dynamic AI-driven consumption-based platform.
Yeah.
And the fact that they can project 20% revenue growth while completely freezing headcount is the ultimate proof of concept.
It really leaves you with a lingering question. If an enterprise software company can maintain 20% growth without adding a single employee to the payroll, how fundamentally does AI redefine software margins across the entire tech industry over the next decade? And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked. Portfolio prepped. Catch you again soon.